Hey guys, it's the Algorithmic Trader here, and today I just wanted to talk about fair value gaps, how I find them, and how I use them in my trading. I wanted to explain in this video how my somewhat unique strategy of fair value gaps is applied, and how I find them first of all, not just using ICT's method, but actually using real volume imbalances that you can determine from small market profiles or volume footprints, and that's really how you find the real imbalances. So I'm going to be explaining and showing that to you today. So first of all, to the basics, how do you determine an ICT fair value gap? So what you want to do is you want to look for a few things. You want to look for one candle that has no wick behind it, no wick in front of it, the space between where no candles overlap it, just one straight candle where there's no overlap from behind or the front. So just a complete, right here, as you can see. That is a fair value gap. That is ICT's fair value gap. That is exactly what it is described as. All of these are fair value gaps, right here. But as you can see, they were broken. So, how do you determine a real fair value gap that actually has a volume imbalance? What you want to do is go to Indicators, Supply, Demand, and Equilibrium Zones by DGTRD. Click it. Okay, drag it from the last candle from the imbalance to this candle. Okay, drag it one candle over to each side. That helps you get a bigger picture. Now, you have the, first of all, ICT fair value, which is no overlap between the candles. So you have that. Now you draw the actual indicator to see if there's an actual imbalance. There might not be an actual imbalance in price, and it's just going up. This is an actual imbalance. There's a lack of volume. That means buyers were so aggressive here that they rapidly pushed price that you could find buyers when you come back down to this area, because this is where buyers were present the first time in such a rapid area. Extend it, and as you can see right here in the middle, that's usually the best. You might want to draw fair value in the center, and that's what he calls consequent encroachment. I just like it because it usually pinpoints your entries better. That's usually the best place to take it. It bounced. Um, your take profit is determined by you, but the bounce is just the fair value gap. So that is how I determine my fair value gaps. That's the best way to do it. So remember, let's look for a short example right now. This is here. There's like a few going down, obviously. I want to look for like a big candle, like right here. Right here. And here. And that's your fair value gap, right? So what's very interesting about this one is that it fills, it consolidates, and it continues. That's really interesting. That kind of confirms that it's not a valid fair value gap. As you can see, there's not enough rejection here. Sellers were not able to step in here. We broke. We came back down. We didn't really do anything until this one. But you need to see a real rejection, right, in price. There's no real rejection here. It fills, but then it doesn't really do anything. It goes down, it comes back down here, and then it rallies again. So you want to see, when you look for fair value gaps, it has to be in context. So you have to have two things: price and context. Without both, you fail. The context here is that we're making a recovery from the lows. We have demand here. It's not shown, but we do have demand here. We rally out of that. We have a reversal point of interest here. We rally out of that, and we're bullishly focused. So we're not going to be taking bearish fair value gaps. So that's why this would have been the valid trade and not this. So you have to take it within context. So here there was a bearish context. There was a bearish narrative. So I'll reapply it to a fair value gap up here, right? We have a downtrend, a rally, a downtrend, a rally, a downtrend. Here's a good example. This is a really clear fair value gap, right? So we take out our indicator, supply demand, equilibrium zones. This is really for the volume profile. That's why I do it right there. I'm going to extend it to this, extend it to this, and there you go. A clear fair value. There's a huge candle and a lack of volume. And what do? We fill it, we consolidate, and then we tank. And that's the real confirmation. You want to see a little bit of consolidation confirming we filled fair value. So this is fair value, right? Buyers and sellers agree on this price here. And then we tank. And we do it again. And then we tank. We consolidate, we come up again, we tank. We keep doing that. So that's a really good example of how to take an entry on a reversal, right? Because we were going up and we're looking for a reversal trade. A good thing to watch for is a break of structure. So we have this low, we broke it, we made a lower low, right? So that's showing an order flow shift. We go up, we don't even quite break the high. We go down again. This is a clear break of this low. That's a break of structure. So this is market structure, we break it, and then the short entry is coming back into this, testing the real fair value gap. Use this tool. This will help you determine real fair value gaps. All right? Use it, and it's really a good way to become profitable. Use it in context. So we have a huge rally. There's a lot of liquidity down here that maybe the market wants to come down and take so we can go for a reversal, right? That's a really good narrative for a reversal, and that's what I took today. So we break structure. This is the good entry that you can take for all this downside, and you would be targeting liquidity. So your exit would be around right here. This was my exit, and then I took this reversal. I'm currently in a swing for this reversal, and I think that's all for today. Thank you for watching, and I'll see you in the next one.